Good morning, everybody. Welcome to the Ask Me Anything webinar today. For those of you who don't know, my name is Sean Sevey with Sevey Wealth Advisors here in Austin. We are a flat fee based consulting fiduciary. We work with clients to help them develop their own strategy and build portfolios based around their goals and their needs and not some arbitrary models. We can talk about that. We can talk about a number of things. But today's session really is an open panel. Ask me anything, and we'll go ahead and get started here. Um, for the Q&A, there is a Q&A button at the bottom of the screen. Feel free to type in your questions there, or I can just open up and allow you all to talk as well. So whatever is better for you. Are there any questions that we should start with? All right. Well, I did get some questions emailed in, and we'll go ahead and get started with those. And if any other questions pop up, we'll go ahead and get started. One of the questions we got emailed in was, are you worried about Social Security reducing their funding levels in the future? Frankly, yes. When you look at the state of the Social Security platform and their reserve funds, right now, the trust forecasts that they're going to run out of money, their reserve fund, in 2033 or 2034. And when you think about the age wave and the number of people that are collecting Social Security, it's the and compare that against the amount of people that are contributing to Social Security, it's just not enough revenue to come in to pay out to current benefit entitlements. So something's going to have to change. One is there's the potential for Social Security reform. You know, I don't know. Government doesn't seem to be all that efficient these days. So getting a bipartisan reform bill that allows the Social Security trust to earn more income. There are a couple of ways that they could do it, right? Eliminate the cap on Social Security taxation on income. There's a lot of things they can do. But I do think for most retirees who are counting on Social Security for some of their uh, their retirement cash flow, I do think you have to have a scenario built of a 20 to 25% reduction in Social Security in the future. I think it's something that call me a cynic, but I just don't trust the government to get it done. There's no minute like the last minute with the government, so we won't really have a solution till 2032, 2033, maybe even 2034. But from a planning standpoint, me being a little bit more conservative, I definitely want to have a plan for Social Security benefits being reduced in the future. So that was one of the questions that we had email in. For those of you who just joined us, I can please go ahead and put your questions into the Q&A there at the bottom of your screen. Or if you want to ask it live, I can certainly activate your microphone and take the question directly. Let me know what's better for you. Couple other questions that were sent in. We've seen a massive run in AI stocks, the technology stocks over the last 2 years. Are you worried about, is the AI ride over? What are your thoughts there? You know, it's really interesting. When I think about the future and what AI is going to do for our society, I don't have a doubt in my bones that it's really going to uh, change things very similarly to personal computing, like we saw in 1994 with the launch of Netscape. But like the internet, it took a lot longer for the promise to actually be fulfilled than most of the early adopters and analysis projected or predicted, I should say. And I think we're going to see something similar here when it comes to AI. It's getting better and better, and there is a parabolic uh, improvement when we see just how well it's improving upon itself. For those of you who don't know, I've got two older children who are off the payroll and one middle schooler. I think it definitely is going to impact the middle schooler's decision on what she majors in college because there's some jobs just I think are going to go away, or more likely are less people are going to be able to do those jobs, and I think of jobs like radiologists, pathologists on the medical side. When you think about paralegals, a paralegal may not be, you may only need one instead of three or four per attorney in a boutique firm. It's really going to be interesting to see what it does. The other thing that interests me is what's out there or what's coming our way that we don't really foresee yet. Um, when we talk about the internet was a great thing and it brought a lot of things to the market. What, but we weren't ready, we didn't, the ability to carry the internet around in our pocket with a mobile phone. We had a little bit with Blackberries and the Nokias, but until the iPhone was invented, bam, all of a sudden now we had the internet in our pockets. And that launched social media, that launched a lot of things that expanded upon the internet's initial promise. And I'm wondering with AI, what's that next level going to be? I'm very curious. If any of you have an opinion, I'd love to hear it. So, a couple questions coming in. Are there sectors you believe are undervalued or overextended right now? Um, I think so. There's no doubt technology is expensive. By any historical metric, there's no doubt that when you look at the trailing or the forward PE ratios of the Mag 7 or the technology sector, there's no doubt that it's expensive. What's really interesting over the last couple of years, though, since say 2022, is it's been expensive, but earnings have come up over the years to justify some of the expenses. Now, of course, the multiple stayed where it was because the expectations ran up. But we've seen the technology index really having a 23 to 25 PE ratio for a couple of years now. And you would think that there's only two ways for a PE ratio to adjust, right? Either the earnings step up to validate those prices or prices fall. And so far, we've seen earnings step up. Now, there is some concern about the circularity of earnings and the like. But I do think that, in general, technology is by all traditional measures, expensive. Um, on the flip side, what's cheap? Um, there's a couple of areas to look at. One is international. International stocks have a much better valuation right now. And with the US dollar in a bit of a climb, or excuse me, bit of a fall, that has only boosted returns on international stocks. Keep in mind, when you invest internationally, we're looking at both geopolitical and currency risks being added to all the other risks that come with stocks. And then lastly, with international, we don't have as much transparency when it comes to earnings. Each country has their own earnings requirements. Here in the United States, we have Sarbanes-Oxley. It's really clear what earnings are, but other countries they don't have the same reporting schedules as the US, and they have more flexibility on which method they're going to report earnings. It's just something to be aware of. So, domestically, energy has been really undervalued lately, although this year that it's taken off, which has been refreshing to see. I do see there are a couple sectors that are out of rotation. The one that I get asked about a lot is real estate, and I do think that's still not attractive yet. Interest rates are still too high, and there's too many headwinds for real estate. But I would say if you look at energy, dividend stocks, we are starting to see a rotation and a broadening of the market breadth. So I would look at those. How do you assess whether an actively managed fund is still earning its fee? That's a great question. When you look at the trend over the last 20 years, there's been a lot of focus on index funds. And when we look at, when you talk about index funds are phenomenal when you have, when you think about what they're designed to do. They are all gas, no brake. They're designed to be risk and tax efficient, all up, all down. There's no real focus on trying to overweight or underweight or any sort of tactical approach. There are, index funds do a phenomenal job in a pure bull market. When the market's going up, the old adage was you could throw a dart at the newspaper, right? That's the type of environment where an index fund is clearly a great place to be. Low cost, actively managed funds, it's really interesting. There are, when you talk about whether it's a sideways market, a down market, or a bifurcated market, like we've seen lately in the last couple of years, where technology has really outperformed the rest of the market. Some of these low-cost, actively managed funds have intentionally overweighted technology to generate excess returns, and they've done well. We here at CV Wealth, we recommend a couple of them. The question is always, it's not about performance because we can't, performance it can be fleeting. It's about the process of how are they picking the stocks? How are they overweighting? How are they underweighting? What's the track record of the manager? It's really important to understand the why behind a fund versus just based on just on performance. And it's a deeper level of analysis than just going on based purely on performance, because performance can change, as we all know, tomorrow. Next question. Are there common tax mistakes you see investors make that we should avoid? I think when you think about taxes, it's a great question. When you think about taxes, I think there's a couple of things that there's two mistakes that clients make. One is looking at taxes on a calendar year basis, or in this year in its individual silo. When we talk about tax strategies, to me, it's really important to limit the lifetime amount of taxes that you're going to pay. And sometimes it means you pay a little bit more now so that you pay less later. A lot of clients understand the terms of required minimum distributions, or understand that Social Security will pay out later and we'll have some taxation. But our tax system is a stacking-based tax system. And what we see is a lot of clients are so focused on maximizing this year's optimization and then deferring money down the road, so that when these other sources of income come in, they're automatically bumped up into higher income tax rates, higher capital gains rates I've seen in the past. It's really having a lifetime strategy for taxes versus a calendar year. That'd be the first area I would want to point out. Second one is looking for hidden taxes. what are some hidden taxes? The biggest one is the IRMA threshold. How much are you going to pay for your Medicare, the Medicare surcharges? That is an income-based premium. And oftentimes, unfortunately, it is a cliff-based. That one's not stacking. That is cliff. If you have $1 over into the next threshold, it can cost you $2,000 a year per person. Easy. And so for a married couple, that's not cheap money when it comes to your Social Security premiums. So having an awareness of IRMA premiums as well as your lifetime tax, it really comes to where are the trade-offs? There's no perfect recipe for every client, but where are the trade-offs? And being aware of that. And then the last one I will say is I cannot tell you how many times clients end up leaving as an inheritance a big IRA. And unfortunately, a number of years ago, the tax rules changed for beneficiaries. They no longer can spread that IRA distribution out over their lifetime. They have 10 calendar years to fully distribute the IRA at ordinary income. And typically, those kids that are full adults in the prime earning years. And so an extra 50, 70, $100,000 a year of income coming out is going to bump them into a higher tax bracket potentially. And so, we've done some Roth conversion analysis for clients where, hey, the break even, it doesn't really warrant us to do a Roth conversion. There's not a material benefit. But because you're in a lower tax bracket than your children are, it would benefit your children for you to pay the taxes versus them and use a long runway of doing that. So it really is understanding those hidden taxes and what the unintended tax consequences are of your income and retirement plan. So those are the three I would really focus on. Next question. What investor behaviors tend to cause the most long-term damage? And how do you help clients avoid them? Oh, great question. I think that when you talk about what does in a financial plan, almost always it's going to be a behavioral decision. You know, there's so many studies. Morningstar has a study they publish every year called Mind the Gap. There's a study called Dalbar that tracks inflows and outflows to mutual funds and ETFs. And we see over and over the average investor underperforms the portfolio, the investment that they invested in, based purely on timing. And we've seen it over and over, right? Our emotions get to us. When things get scary, like they did in April of last year when we had the tariff tantrum, there's this gut feeling to protect, especially when you're retired and you don't want to have to go back to work and you can't make up the losses. There's this inclination to get conservative. And all we typically do is end up locking in losses. Conversely, we see a lot, we see these mutual fund flows where money flows into investments after they've already run, right? Fear of missing out or the like, And so we end up seeing a lot of buy high and sell low, which, as I hope you're aware, we want buy low and sell high. And when you talk about the behavioral side of investing, it's really, really important for you to understand what's your plan for volatility, because it's going to happen. We know that in any year, a 10% pullback is the average, right? In any 3-year cycle, a 15 to 20% pullback is the average. And on a 10-year cycle, a 25 to 30% pullback is historically average. So what's your plan for that volatility so that you don't have to sell at the bottom? I would say the biggest thing for investors, the biggest mistakes I see is not having a plan for volatility before it happens. And then 2, not having a dedicated sell strategy. What are you going to sell, when, and why to fund your retirement? We have a lot of clients who, I'll just sell something this year, I'll sell something that year. And then we get into a year like we saw in 2020, where the Fed raised, excuse me, 2021, where the Fed raised interest rates up to slow down the economy. So both stocks and bonds fell in concert with each other. We're all told for decades, right? Bonds and stocks have this inverse correlation. It's not always true. And if we don't have a plan for what are we going to sell, when, and why, then unfortunately we then subject ourselves to either the whims of the market or the whims of our emotions. And that to me is almost always a recipe for disaster. So I would say, proactive, intentional planning around taxes, around risk, around where your cash flow is going to come from is the best way to offset some of these investor behaviors that tend to cause that long-term damage. Where would you suggest I invest $50,000 today? Oh, good question. I have no idea, frankly. It really, it's a cheap answer, and I apologize, but it really does depend on what the rest of the portfolio is. I for us here at CB Wealth, we are focused on a time-based horizon. What's your time horizon for the money? If you don't need the money for 10, 15 years, there's no reason not to take risk. Even at these valuations, there's no reason not to go ahead and be aggressive, some way, somehow, whatever that looks like. If you need the money next year with where valuations are, I'm not sure I would be willing to take on a lot of risk. Bonds have a really attractive valuation right now. And with the market having its a little bit of rotation earlier this year, but if I needed the money 2 years from now, I would probably be pretty conservative with the money. Don't need it for 15 years, I'd probably be pretty aggressive and find something that I'm willing to buy through. The other part of that is whenever you invest money, you have to know, okay, this is what we think is going to go right, but what could go wrong, and what would change our thesis? What would make us change away from this trade? Is it a function of earnings? Is it a function of Fed cuts? We were expecting X amount of Fed cuts. It doesn't look like we're going to get them, things like that. It really is, what's the thesis around the investment? So I know it's kind of a cop-out answer. I'd love to be able to tell you, oh, buy, Acme Materials, because I think it's going to do really well. It really does depend on your time horizon. It depends on the rest of your portfolio, of how you're invested. It depends on your risk tolerance and your risk capacity, which, by the way, are two different things. Risk tolerance is your emotional. How much risk can you stomach before, or how much loss can you stomach before you start to set in and panic? Risk capacity says, how much risk can the portfolio take before it breaks? And those two numbers, or those two risk assessments, rarely are the same, but it does mean it's a great way to kind of frame where that $50,000 would focus. Is it part of your long-term, don't need this money, it's probably a legacy investment, or hey, I need it in a year or two? That's where I would start. Good. All right. As a reminder, for those of you on the call, feel free to add questions at the bottom of your screen. There's a Q&A. If there's a question you would like to have, feel free to throw it out. Let's see. I'll go back to some of the questions that were emailed in while we wait for more questions to come up on the live Q&A. Are you worried about a recession currently? Yes, but I'm always worried about a recession. When you think about where we are in the market, where we are in the economics scale, this bull market started in May of 2009, coming out of the housing bubble. The secular, the long-term uh, trend has, we're in 2026. So we're going to come up on a 17-year bull market. Um, that's a long time. And eventually, bull markets will eventually end. We know that. We've seen it time and time again. So, from a secular standpoint, yes, I do worry about it. The cyclical bull market that started in October of 22, that is in a very natural place. It falls on the average trend line where we're starting to see maturity signs. We're not seeing the parabolic growth, but we are starting to see it level out. But I do think there's still room to run. Here, we're still cautiously optimistic about the markets over the next year or two. But I do think, when you think about the markets. Um, I've been doing this 25 years. My career started on March 1st of 2000. And if you were investing back then, you'll probably gather rather quickly that that was the peak of the tech bubble. Well, March 4th technically was the peak of the tech bubble. Um, you know, early in my career, I watched down markets. 2000 we lost 9%, 2001 we lost 12%, 2002 we lost 22%, right? Cumulatively, we lost 45% in 2.5 years. When we look at some of the recessions we've had since then, we've had some short, brutal winters along with some long, beautiful summers. We see these long growth periods, and then COVID hits and we lose 39% in 36 days. Or we see the Fed raise rates to slow the economy down and we lose over 20%. We saw the tariff tantrum last year where we lost over 20% in less than a week. Like long, beautiful summers, but short, brutal winters. And I think, especially if you're retired, you have to have an awareness and a plan that these brutal winters absolutely are going to happen, and we have to have a plan for them ahead of time. The other part, the other question, which wasn't asked, but I get it frequently, is there are some firms out there, Goldman Sachs, Morningstar, and Morgan Stanley, to call them out, who are saying the next 10 years are going to be underperforming the previous 10 years. Um, I don't think we're going to, they're not calling for a recession. They're not calling for a bear market, but they are saying, hey, wait a minute, based on these starting valuations, based on interest rates and things like that, the the projected rate of return, Vanguard right now is saying the next 10 years is going to average about anywhere from 4 to 6%. And that's a lot lower than the historical 10 or 12 that we've seen recently. And so I think that there's a couple of reasons. I'm not saying they're right. I'm not saying they're wrong. But if they are right, and you look at where bond evaluations are, giving us roughly 4% in corporate bonds, bonds take a quarter of the risk of the stock market. Whereas, from a standard deviation standpoint, I think it's something to be aware of. I'm not sure, and there's really two paths, right? We could either see a plateau where the stock market just kind of trades sideways. It did that in the 50s, right? Coming out of World War II, the market traded sideways and then took off. Or we're going to see this market continue to bubble up, and then bubble concerns are valid, and we would see a correction. I don't know which path we're going to see. If I were that smart, I'd be running a hedge fund from a beach and a golf course. But I think it's when you have big firms like Goldman and Vanguard and Morgan all saying relatively the same thing, it's definitely something to pay attention to. So good. All right. As a reminder, if you joined us late, feel free to throw in any questions into the Q&A tab at the bottom of the screen. Next question that was emailed in. Everyone is talking about President Trump nominating Kevin Warsh to replace Powell at the Fed later this year. How should we be positioning our bond portfolios for a potential shift in Fed policy? It's a good question. I don't think Kevin Warsh is going to have nearly as much influence as a lot of people are worried about. Chairman Powell is his term as chairman ends here in a couple months, but his term as governor doesn't. He has the right to stay on the Fed as a governor through I think it's 2029. Um, and so, you know, yes, it's true historically. Um, a Fed chair when their term ends, they leave the Fed and resign. I'm not sure Powell's going to do it. I really am not. I think he is so concerned about the independence of the Fed that he is going to stay on. And if that's the case, you're going to have three Trump loyalists and nine, I don't want to say disloyal, but traditional governors on the Fed governing board. I just don't see it as a major change to Fed policy um, unless unless we see more governors come off. And there's only one additional that's scheduled to come off before the president's term is up. So maybe he gets a fourth governor, maybe fifth if Powell leaves, but seven of them are going to stay. And I'll be very curious to see um, what Powell does if he stays on. I think it's going to be really interesting to watch. Um, so go from there. Let's see. Cash yields are attractive, but if the Fed pauses or cuts, that won't last. Is it time to move my sideline cash into bonds, or should I stay in money markets for safety? Great question. When you talk about bonds, right? Bonds are an asset class that we invest in to earn money, earn interest on our money, and to get our money back, right? It is, and when we think about bonds, bonds are a loan. We are loaning our money out. We want interest and we want our principal back. Whenever we loan money out, we're primarily taking on three risks: credit risk, duration risk, and interest rate risk. And let's go in reverse. Interest rate risk is, what does the Fed do with interest rates? Do they raise them? Do they lower them? Or do they stay neutral? Credit risk is the borrower repaying us our money. What's the probability or the risk that we're not going to get our money back? And then duration is not the average maturity. It's actually a calculation based on the price of the bond and other factors. How many years of interest payments do we need to receive to be made whole for the risk that we're taking? That's what duration is. And so, as you can imagine, the longer the duration, the longer the bond, the more sensitive we are to credit risk and into interest rate risk, right? Very simple, right? If you loan money for a year, the probability of the Fed raising rates this year is pretty low. Could happen, but it's pretty low. So we're not worried about Fed hikes this year. The credit markets are relatively stable. We're not overly worried about credit risk right now. So on a 1 year time frame, probably not a high risk when it comes to loaning money out for a bond. Google just announced a 100-year bond to fund their AI. What can go wrong for Google over the next 100 years? There's a lot of things, right? The companies that we thought were phenomenal 50 years ago, some of them don't even exist today, right? So there's a lot of risks with the longer the bond, the more that can go wrong. And so when you talk about owning bonds, it is an intentional step up on the risk scale from cash. If the Fed cuts rates one or two times this year, then they're going to approach their neutral target. That's where we're likely to see it's That's where we're likely to see them kind of settle in. And at that point, there's not much juice left in the lemon for bonds as far as appreciation. It's now a focus of um, owning bonds for safety and stability. It also will depend if you own bond funds or individual bonds, and we can have that discussion offline as to which one is better for you in your situation. But I'm not afraid of bonds right now, but I do think you want to be really intentional with your bond portfolio. Okay, good. What do you think about STRC as a replacement for a portion of the bond portfolio? STRC, let me pull that up real fast. Make sure I'm talking the same thing. All right, let me make sure this is what we're talking about, the S&P Target Risk Growth Index. I don't want to call out your name, but uh, the person who put that in, if you'll confirm, that's what you're talking about? All right, let's see here. Oh, MicroStrategy. No, STRC, the MicroStrategy preferred stock. Okay, got it. So preferred stock is a hybrid of a stock and a bond, right? When you think about why corporations issue preferred stock, it is it's a really unique investment. Preferred stock does not show up as a liability on the balance sheet of a corporation. It doesn't have to go through the full underwriting that a traditional bond would. Because of that, they have to pay more interest of the preferred stock than a traditional bond. These are often done as short-term financing structures, 5 years versus a long-term bond. But they take on extra credit risk. And the when you think about preferred stocks, right now they are, credit risk is really the credit spread, the amount of extra interest you're earning for taking on credit risk over treasuries is really narrow. There's not a lot of credit risk. The moment we see any sort of risk come to the credit markets, this is going to underperform pretty quickly. Regarding MicroStrategy, I'll have to dive into it. You and I can have a conversation offline, and we can talk about this specific investment and how it fits into your portfolio. But I do want to say, preferred stocks in general, I'm not sure that that's the best place that I would be if I was looking to take on risk in the bond market. I think personally, I'd rather look at international bonds. I'd rather take currency risk than credit risk with credit spreads so narrow. But that is a much deeper and personalized conversation than an open QA. So perfect. I will go ahead and look that up and circle back with you offline regarding that specific. If anyone else wants to have that specific conversation regarding the MicroStrategy preferred stock, happy to just send me a note afterwards or ping me in the Q&A saying, please have that conversation one-on-one with me as well, and we'll get that scheduled. Good. Let's see. Any other questions coming in? Let me go back to the emails real fast. Let's see. I think here we go, last one. Private credit and private equity have become much more accessible to individual investors recently. Do these belong in a standard retirement portfolio, or are the liquidity risks too high right now? Great, great question. So when you think about private equity and private credit, there is a school of thought that says, when you think about diversification, diversification is stocks, bonds, and cash, right? You can also, that's on the vertical axis. On the horizontal axis, you also can add in public markets and private markets, right? Private equity, private debt. There's no private cash, but you get the point. Um, the beauty of private debt and private credit is there is the opportunity for outsized returns, no doubt. But you have to go back to why a company would issue private equity and private debt as opposed to going to the public markets to borrow. And oftentimes it's because they are either a giant credit risk or a higher credit risk, and they can get better rates by going to private debt than they can to the public credit markets and paying high yield rates. Or it is some sort of leveraged asset. A great example on private debt is airplanes. A company like a company like United Airlines can put up collateral to a private debt to go out and buy new airplanes. And what they'll do is they'll put their existing fleet of planes up as collateral. And in return, they get a line of credit, they get the money to borrow, and then turn around, order new planes, sell off the old, and pay off the debt. It's good business. It makes a lot of sense. But as the question was brought up, it's not all that liquid, right? Getting your money back out. So to me, going back to the time horizon, right? If this is 15-year money, sure, there's definitely a potential place, depending on your risk tolerance, your risk capacity, and your overall liquidity. Like you can't really need this money for many years. Otherwise, I tend to say most clients don't need it, um, only because it comes with high fees. And oftentimes the fees outweigh the extra benefit. So it's a case by case scenario. I know Vanguard started launching a private equity component. We know Goldman and Morgan and Merrill, they've done it for years. Um, I have some clients who have a vast amount of these private strategies, and they are case by case. Some hit, some don't. And in the end, we tend to see average based returns when you net it all out. So I'm not someone who thinks they are a critical component to every portfolio. It's more case by case. So good. Um, all right. That's the last of the questions that were emailed in. I'll take a last call for open Q&A before I go ahead and wrap up. Okay. Well, let's go ahead and wrap up then. I thank everyone for joining us today. As a reminder, CV Wealth is a firm. I spent the first 22 years of my career between Fidelity and Schwab. Got really tired of product-based sales goals, got really tired of high fees when, from my side of the desk, the amount of work doesn't really change on a $2 million client or a $5 million client. But for, under the traditional model, we tend to charge double for the $5 million client. It doesn't make sense. So I wanted to build a firm that was based on the client first, acting as that true fiduciary, and building portfolios around every client's individual lives than general models. So depending on where you are with your portfolio, with your plan, would love to have a conversation and learn if my firm can add value, save you fees, help you out in any way. Last call for questions up. Perfect. Thanks for the thanks for the praise. Thanks has been helpful. I hope you have more AMAs. Yep, I think we're going to do this at least quarterly, maybe monthly, depending on what's going on, but we will absolutely be doing more of these AMAs. I will be sending out a short survey we did record this, so if you want to get a copy of the recording, just send me a note, either here in the Q&A, send me an email, sean@cbwealth.com. Thank you all for joining. I hope everyone learned something today, and let me know how my firm can best support you. Until next time, bye-bye.